and that will continue over the course of the next few months. Videos, testimonials, and more are now live on Citizen social media channels, so I encourage you to take a look at them, leverage as you will, as this milestone, is a way to engage, continually engage in the social conversation to enhance your own visibility as having been named a champion. And finally, we've developed this 3-part webinar series focused on the topics that you told us that you want to hear about. So today's session is focused on managing nonprofit finances. We know this is an area you've asked for more insight and some best practices on. We've convened an incredibly knowledgeable panel for you today. Moderating for us is Lisa Murray, and I'm going to now introduce you to her, and she'll share a little bit more about this session. Lisa is the Director of Not-for-Profit and Professionals Banking at Citizens, and she also serves as the Massachusetts State President for the bank. She has been in commercial banking for more than 30 years, has experience in retail, middle market, specialized lending. She's a tremendous advocate and supporter for our Champions program, and we're excited for her to be with us today. So Lisa, I will hand it over to you to introduce our presenters and get us started.
Great, thanks, Kathy. Thanks to all our not-for-profit partners who have joined us from across our footprint to listen in on today's session. As Kathy shared, I have been a huge fan of this program since it began at the bank. Through our Champions in Action program, in Massachusetts alone, we've supported nearly 60 nonprofits, providing them with more than $1.6 million in funding and support. I have truly experienced the impact of organizations like yours, and I'm continually inspired by how we can work together to make stronger communities. I'm so excited to connect with you all today and with our presenters, provide guidance on finance topics that ultimately will help you better support your mission. We've convened several fantastic presenters today. First off is Hasty Cutshall, who joins us today from Your Part-Time Controller, a nonprofit financial management organization. Hasty will share her expertise around the basics of what makes nonprofit accounting unique, and we all know it is unique, along with best practices for nonprofit financial management. And then Mike Ouellet joins us from Citizens Nonprofit Banking Team, where he works with hospitals, colleges, community health centers, social service agencies, and more to provide capital financing and other commercial banking solutions. And today, Mike will share information on credit products, underwriting considerations, and more. And then finally, William Mungai is a Treasury Relationship Manager here at Citizens. William will speak about cash management solutions, including treasury trends, payables, receivables, and the ever-present fraud. So we'll be covering a wide range of topics and hope that this session provides valuable insights and tangible takeaways. So with that, let's get started with Hasty. Hasty?
Thank you, Lisa, and thank you to Mike, who first invited me, and to the entire team that's made this program possible. I'm going to talk briefly this morning about some basic concepts in nonprofit accounting and finance. Moving on to, as Lisa said, I work with Your Part-Time Controller. We have for almost 30 years now. We're celebrating 30 years next year. Been advisors in accounting and financial management, specializing in nonprofits. So we love helping organizations that are helping the world. So we can move the slide to the next. And again, thank you. So we're going to start with some basic financial concepts, as well as then move into some basic, some best practices for financial reporting. There are some best practices as well for governance that are included in the slide deck, but at the end in the appendix. So if you'd like to see more, for time constraints, we weren't able to cover all of that here, but there's some good information there for those of you who are looking to strengthen your financial management processes in your organization. We're going to start with some basic differences of what makes nonprofits unique and how do those unique characteristics affect accounting. Nonprofits aren't in business to make money for anybody other than they're there for a mission. They receive revenue in many different forms to provide services, sometimes goods, to organizations, to constituents of organizations. So there's a purpose or a mission that drives their activity. Likewise, an absence of ownership. So even if the nonprofit does budget and have a surplus at the end of the year, that surplus stays with the organization. That does not accrue to any individuals. There's a board that governs and makes the decisions for the organization. And nonprofits are also unique in being able to receive contributions as revenue. You don't hear that concept, of course, in the commercial world. So it's these basic concepts that lead to unique accounting issues for nonprofits. Among those are the way we select our accounting software, accounting systems. We're not using ledger paper anymore. We're no longer work like Bob Cratchit. Most organizations are using an accounting software such as QuickBooks. Xero is another small one, but there are larger ones like Financial Edge, MIP. There's quite a range. And things to consider in choosing the right one, of course, are cost, complexity, ability to learn, and functionality. How is it going to work given the way your culture and your organization runs its operations? But also think about the reports you need, and can the software parse the data in all the different ways that you need to look at the information on your activity? Can it handle your budgeting? Can it produce reports for both management as well as external reporting needs? All of those factor in. QuickBooks is, I'm not here to pitch any software, but QuickBooks is certainly very prevalent, and when used, can be used very creatively to structure it. It's getting better and better and can handle some very large organizations' needs. But consider also the needs to integrate with other systems you might be using, a donor management system, or such as Salesforce or DonorPerfect, things like that. And then can the system be used as part of your document retention process? In many organizations, they attach a PDF or a picture copy of the support behind their transactions into the transaction as it's entered into the system itself. And so the system can become your filing system, and that can make for a lot of time savings at audit time, especially. In setting up the system, you want to look at all the different accounts that you'll be using. Set up that chart of accounts in a logical way. Of course, you'll need balance sheet accounts, which are the assets, the liabilities, your equity accounts. Your assets are the things that the organization owns. Cash, of course. You might have property and equipment. You might have investments. There are also likely going to be obligations such as accounts payable. You may have some payroll obligations that recur with each cycle. These are the things the organization owes. And the difference between the two, the equity in nonprofit speak, is called net assets. So if you look at the accounting equation down below and do a little bit of basic algebra, assets minus liabilities is equal to equity. The income statement accounts, the difference between your revenue and expense actually feeds straight into the equity section. So this is not a class in basic accounting, but in the chart of accounts, you need to include those accounts because they all tie together. Your revenues are whether you're earned or contributed. You may get money from different government entities, from foundations, lots of possible sources. And then the expenses are the costs that you incur to carry out your mission, as well as to cover the supporting services that are there to essentially make things go, make things work. On to another reporting or concept that's unique to nonprofit accounting is the fact that we both have to report on, but we think about our expenses, and they need to be tracked by both nature and function. And when I say nature, I'm saying, are you coding an expense that's for salaries or for a telephone bill or insurance? What type of expenditure are you making? And then by function, I mean, are you paying something that's going to be part of your program services? or is it a supporting activity such as management and general costs, fundraising? If you have members, membership development is also considered part of the supporting activities. And this leads to the notion of the need to allocate some costs. We think in terms of direct and indirect costs. Direct costs are those that are easy to identify with the work you're doing, the program, the activity that is part of your mission, such as supplies. If you're teaching, running a school, supplies for the classroom would be direct program type supplies, versus indirect costs, such as accountants or insurance or rent in many cases. But you may also buy supplies that are considered indirect because they're used in the back office. They may be used throughout the organization, and it's hard to pin down exactly where they're being used. So that requires the idea of allocating some of those shared costs so that you can show fairly what each of your programs, whether they're covering their costs, their share of those shared costs or not. And just in the past 6 to 8 years, FASB has added the requirement that organizations must articulate their allocation plan, how they allocate their shared costs in an audit. And many funders will also talk about that because they're looking to make sure the organization can steward the money that they may donate. We're going to look ahead to some financial reports that are very basic. Not only are they required reports to be issued in an audit, but they're also very good management level reports. So a statement of financial position is what is the nonprofit term for a balance sheet. It's put together the same way, but we have different terminology in nonprofit land. Your P&L, your income statement in a nonprofit is called a statement of activities, and the net results of those activities then goes into showing a change in net assets. You often will see that on the statement of activities. The statement of cash flows is kind of a nerdy accounting report, but it's very important to those of us that use them, because if you're booking on an accrual basis, it translates your accrual-based income statement or your net activity back to the impact on cash. And most organizations, of course, are very keen to keep track of what's going on with their cash balances. And as I mentioned, that expense analysis, which is often called the statement of functional expenses, also must be provided. It can be included on the statement of activities, but if you do it there, it can get kind of crowded. So most organizations are showing that as a separate report, sometimes in the notes, but I see more typically in the main statements themselves in an audit report. So now we're going to look at some tips for working with the different key reports. Common errors on a statement of financial position or your balance sheet is failing to record everything that you own or everything that you owe. If you're working on a cash basis, there are going to be some things missing that might be useful to, especially an outside reader. We're working with a museum up in Maine right now that just discovered a $300,000 endowment that had never been booked. They were receiving income on it for years, but neither the staff nor the auditor had picked it up. So they've now got a stronger set of net assets on their balance sheet. Another mistake is often to include funds in current assets that are donor restricted, so not available for current or unrestricted use. Many organizations make the mistake of putting board designated net assets into restricted net assets. If the board made the restriction or the designation, it's still unrestricted money. Only a donor can restrict money. So in the parlance that is common now, the board designated net assets go into the section without donor restrictions, and anything that's been restricted by a donor goes into the with donor restrictions. And sometimes we see donor restricted revenue deferred when it really belongs either on the income statement or if it's already past the turn of the fiscal year, down in the net assets. And then a failure to perform monthly bank recs, something as basic as that, including the account reconciliations. If you're issuing reports without having done those, then I can pretty much guarantee the reports are inaccurate. On the statement of activity, likewise, be sure you're picking up all the activity. Again, if you're showing things on a cash basis only, you may be missing some key information. Many organizations forget to release their donor restricted gifts once those restrictions have been met, and sometimes may look like they're starving themselves because the unrestricted net asset balance is diminishing when they really can actually release some of the donor restricted net assets. Same as on the balance sheet, you can report revenue in incorrect categories. It's restricted versus unrestricted, and certainly for 990 reporting, you need to segregate your government funding from individual donors, foundation gifts, things like that. We also see a lot of groups that fail to report in-kind contributions, and even though they don't change the bottom line on your income statement, by reporting those, you do show an increased level of community support, and that can often make a difference to potential funders. Some groups fail to even show their fundraising expenses. They may bundle them in with G&A expenses, and it's important that they be segregated. On the statement of cash flows, common errors are to fail to display donor restricted contributions for capital assets as financing. If someone gives you money to build a building or replace a roof, that cash in, that activity goes through the financing section rather than the investing or other operations section. Netting purchases and sales of property and equipment. They should be shown as gross, reporting interest expense rather, instead of actual cash, since this is a statement of cash flow. And likewise here we often see a note about non-cash gifts that can make it easier. It doesn't have an impact on cash, but this is where we commonly see a note about gifts in kind as well. Other reporting needs, that statement of functional expense I alluded to, break those your expenses out into the functional expense categories, be they program management or fundraising. Most groups do show a statement of functional expense, and as I mentioned before, if you're in an audit situation, you need to be able to articulate the method you're using to allocate those costs. Additionally, of course, many of you may maybe already be receiving an audit or maybe facing an audit. An audit can be a scary subject for many people, but it really doesn't have to be. You can be preparing for that throughout the year through good practices in your financial department. An audit is a series of procedures that tests whether the transactions have been recorded appropriately and whether the internal controls in place are doing what they should. It's to be performed by a CPA who's independent of the organization. The rules on independence are slightly different in every state, but really are important so that there's no collusion or of any kind possible. The objective is to receive an opinion that the statements have been presented fairly, so that you can rely on them as a fair representation of the organization's financial position. So the goal is for an unmodified or a clean opinion. Now you can have clean financial statements, but you may still get a letter about findings on your internal control system. And that's an obligation the auditors have to let you know that, one person is doing too many things. So be sure you ask about that management letter and read through it, because you can learn a lot there as well. Audits, why have them? They're not, some people think of them as a necessary evil, but as noted in some states, they're the law. In Massachusetts, if you take in more than $500,000 in revenue during your fiscal year, you're required to have an audit. Many other states have laws requiring audits. They're usually higher thresholds. If you're borrowing money from a bank like Citizens, the bank may require an audit to validate their decision to work with you. It may be required by your funder or your grantor. In some cases, certainly in government-funded situations, they may require an audit. But it's also a way of providing credibility, not just to your funders, your outside readers, but to your, if you have members, to them as well. And it's a great opportunity to learn something. I've learned a lot from my auditors over the year, and they're there to provide ideas and guidance. IRS 990, we're all familiar with. It's an information return. It's considered a tax return, but it's more for information. It's an opportunity to provide not just financial information, but also description of your major programs, your governance practices, how you compensate your key employees. It's a marketing tool, really. It's due, say, if you have a calendar year end in December, it would be due by May 15th, that 15th day of the 5th month. But you can get a 6-month extension for filing, but you do have to apply for it. If you don't file on time, penalties may be levied. Failure to file for 3 years in a row you could lose your tax exempt status, and that's a huge burden to have to repeat. So make sure you're filing on time every year. Why the 990? We're informing both the public as well as the IRS. As I mentioned, it's a marketing tool. It's available for public inspection on GuideStar and other similar charity watchdog sites. Potential donors and grantors do look at 990s. We always look at the 990 before we talk to potential clients because we can learn a lot from them. And charity watchdog organizations will use them sometimes to rate the potential effectiveness of the organization. It's a way of also keeping the IRS informed that you're meeting the mission that you applied and said you would meet, and that you still qualify for your tax exempt status. Here are some resources to look for. As noted, there are some additional slides at the end of this program that will be made available to you if you wish. And I'm going to turn it over now to Mike.
Actually, I just want to jump in here. Thanks so much, Hasty, for sharing your expertise with us. Lots of great information and tips that I know will be helpful to our audience. And now I will turn it over to Mike, who will sort of walk you through how we as a bank look at not-for-profits and how we are trying to support you and your mission through credit products and other bank services. So Mike, take it over.
Great. Thanks a lot, Lisa. Good morning, actually, everyone. It's a really pleasure to be with you all today. So as Lisa said, in my role as a corporate banker on the not-for-profit banking team, I try to help our clients finance their mission using bank credit facilities if they need them. Typically, that means lines of credit, term loans, or standby letters of credit. So I'm going to talk a little bit about those, as well as our credit approval process and the credit approval criteria and considerations that we use in evaluating the creditworthiness of potential clients of ours. So next slide, please. So first up with lines of credit, we in banking, we talk about the working capital cycle or the cash conversion cycle. That typically refers to manufacturing and distribution companies. It doesn't really apply to nonprofits, which are more, service-oriented businesses. So when we do have clients with lines of credit, they typically have them in place to cover timing differences that might exist between, when they receive funds in from the government or a grantor, or when they have to, disperse payments. Now, fortunately, in my experience on the not-for-profit banking team, most of these funders understand, the razor-thin margins that nonprofits are operating under. So they do tend to get them funding on time, which is great to see. Many nonprofits still do maintain lines of credit, but they're typically not used that much. So they're really there for insurance purposes. Lines of credit can also be used for capital expenditures. We often see that if one of our clients has an opportunity, for instance, to purchase real estate, they have to act quickly before they can put a term loan in place. So they would draw down on their line of credit, finance the real estate purchase, and then, term out the borrowing on the line of credit at a later date. And then lines are frequently used for standby leverage credit, and I'll get into those in a little bit. In terms of some of the features on lines of credit, lines of credit are revolving credit facilities, which means you can borrow on the line, repay, and then borrow again on the line. And that contrasts with non-revolving credit facilities such as a term loan, which as you pay down the term loan, you can't re-borrow, obviously. Interest rate on lines of credit. In this environment, it's really important to note that the interest rate charged is a floating rate. It adjusts with market rates, and obviously right now rates are rising pretty dramatically. So if you are in fact borrowing on your line of credit, you really want to keep track of that, what you're paying for interest expense. And the interest rate banks charge, really, it's based on two components. There's an index and what's called the spread, and the loan spread is based on the risk profile of the borrower. So obviously, the riskier the borrower, the more they're going to be charged for the line of credit interest. Right now, banks are using an index called LIBOR, which means London Interbank Offered Rate. That index is actually going away in June of 2023. So if you do have a line of credit and your current index is LIBOR, you might want to communicate with your bank to find out what's going to be happening with this transition. There are a number of other new indices out there. One is called SOFR, one is called BSBY. Those are both acronyms, which I won't get into, but you want to be aware of that. Lines of credit are usually secured by an all-asset lien on the assets of the organization. Covenants I'll get into in a minute. Next slide, please. Lines of credit can be either committed facilities or uncommitted facilities. There's a huge difference between the two. With a committed line of credit, the bank is really under a contractual obligation to provide funding to a borrower if the borrower makes that request. With an uncommitted line of credit, it's really at the bank's discretion whether they want to make the advance or not. They're often called demand facilities as well, and oftentimes the language in the loan agreement will say that you can use the line until the bank makes demand, or the drawing would be at their discretion as well. So the safer alternative for most borrowers, is to have a committed line of credit rather than uncommitted line of credit. I guess the offset with a committed line of credit, because they're considered riskier for the bank and they're generally committed for longer periods of time, there's an unused fee that gets charged on the line, and they generally have a higher spread. And the other major difference between a committed line of credit and uncommitted line of credit is financial covenants. So banks will generally look at your budget, look at your financial plan, and establish what we call covenants that track your expectations. Typically, they're set against your debt service coverage or your liquidity, and those really set up as guardrails so that if you deviate from your plan and violate the covenants, banks, even though the loan agreement might say that the bank has the right to accelerate your loan if you're in violation of covenants, the fact is that it's very, very rare that banks do that. The real purpose of the covenants is to just get us together with our clients to figure out why they deviated from their plan and what action plan they're putting in place to get themselves back on track. One of the other things about committed lines of credit is that the loan agreement would have to be amended because we have a hard maturity date. So that would be an annual thing in most cases, and there would be a legal fee associated with that amendment, although it is not that material. Uncommitted lines of credit don't have to be amended because they are provided on this demand basis. Next slide, please. I said that most of our clients have lines of credit, but they're not used that much. Term loans, on the other hand, are used pretty considerably by our clients. And generally, the purpose for most term loans is for real estate purchases. Many of our clients provide care in congregate care services in congregate care settings, such as for people with developmental disabilities or substance misuse disorder. So we have some of our clients own 40, 50, 60 properties to provide these services. So that's generally where we see term loans used. They can also be used to make acquisitions as well. That's not as common, however. Term loans, they the length of the term loan can really vary, but generally we see term loans in the 5 to 10 year period. Now, while the term loan itself would mature after a 5-year, 10-year period, usually we're amortizing the loan over 25 or 30 years so that the payments, the annual payments or quarterly payments aren't that onerous for our clients. Funding usually of a term loan usually takes place at the closing, but there are situations where it might make sense to use what's called a drawdown term loan, where you're borrowing over time. If, for instance, you have a construction project, you don't necessarily want to borrow all the money at the start of the project because you'll be paying interest expense throughout the 1 or 2 year construction period. So it's better to draw down that loan over time to minimize your interest expense. And then at the end of the term, at the end of that period, you would convert it to an amortizing term loan. The interest rate on term loans, unlike with lines of credit, is a fixed rate, which is really important because the loan is outstanding for a longer period of time. So borrowers are exposed to interest rate risk, meaning rising interest rate environments. So you really want to have a fixed rate on those loans, and banks can provide those. They can fix the rate in one of two ways. It's actually a fixed rate loan, or we can provide a floating rate loan with and fix the rate with an interest rate swap, which is generally what the banks do with larger term loans. Term loans are usually secured by the asset that they're financing, and they can be either taxable or tax exempt. With a taxable term loan, there are just really two parties involved in the transaction. The bank is lending money to the nonprofit. With tax exempt financing, there are actually three parties involved. Usually a development agency in Massachusetts. It's called Mass Development. So Mass Development would issue bonds. The bank would purchase the bonds, and then the funds would be lent by the Mass Development to the nonprofit. The benefit of tax exempt financing is that because banks do not have to pay taxes on the interest income earned, we provide a discounted rate. And right now, I think the discount is 21%. So there can be a pretty sizable savings for nonprofits that can access tax exempt financing, which generally, because of the complexity and time involved and number of law firms, the cost, generally tax exempt financing is done for larger transactions, maybe $1 million or $2 million or even higher than that. Financial covenants, I addressed that already. As with committed facilities, we would also have that with term loans. And then with repayment of term loans, banks can be pretty flexible and creative with how those loans are repaid, but generally we amortize term loans in one of either two ways: straight line or mortgage style amortization. I think people are probably familiar with mortgage style amortization. And actually, on the next slide, I think I have illustrated how. So what this is trying to demonstrate is the differences between straight line amortization and mortgage style amortization. And as you can see, with straight line amortization, you reduce the loan balance much more quickly than you do under mortgage style amortization, which helps you reduce the amount of interest expense that you would incur over the life of that loan. The downside with straight line amortization is that, as you can see, the total annual payment is much greater than it would be with mortgage style amortization. So, and sometimes people find it easier to budget and plan when it's mortgage style because they're paying the same month. And these are all broken this down by annual, but usually we're collecting money on a monthly or quarterly basis, but people just find it easier to manage and budget. And I'd say that most of our clients do use mortgage style amortization. Next slide, please. Standby letters of credit. Many of our clients use standby letters of credit. They're actually required to by their landlord, so they're typically used to support real estate obligations. Essentially, a standby letter of credit gives comfort to the landlord that if for some reason their tenant defaults on their lease payments, the bank will step in and make those payments up to the standby letter of credit amount for the applicant, which would be the nonprofit in this case. Now, typically, the amount of the LC is built into the lease agreement, and it's usually a negotiated amount based on certain number of months of rent. So that's something you might want to look at if you are required to issue a standby letter of credit. Just talk to the landlord to see if you can get that amount reduced if possible. And if not, many landlords will also accept a reducing schedule of standby letter of credit requirements over time. One thing to keep in mind with that is that if you are able to negotiate for a reducing LC, that's often in the lease. It's built into the lease, but you want to make sure that you build that into the letter of credit. We've had situations where borrowers, nonprofits are entitled to reduce their LCs, but they don't notify the bank because they forget about it. So they're paying extra fees when they really shouldn't have to. The other thing I wanted to say about standby LCs is that it's really a good idea to have a sublimit under your line of credit to issue LCs. I mean, it does require a credit action, and while it generally is easy to get standby letters of credit approved, if you have to scramble and get something done quickly, it's much easier if you already have that credit approved via a line of credit with a sublimit under the line of credit for issuing standby letters of credit. So that's something to consider as well. Next slide. In terms of the credit approval process, we as bankers, I like to say we're very curious and inquisitive. We'd like to spend a lot of time with our clients, really getting to understand their business and how we can most support them. So we tend to gather a lot of information. Kathy was talking earlier about the financial statements, income statement, balance sheet, all those important financial documents. So we gather that information, we distill it, we try to develop a financing that works for our client. We would present that to our credit department in what we call a screening process. And assuming the credit department finds the borrower creditworthy, we would then go back and provide a term sheet to the nonprofit. And typically we would negotiate the term sheet. And once we and the nonprofit agree on the terms of the financing, we would move forward to our underwriting process, which is just we tend to gather a little bit more information for the final underwriting, and hopefully get credit approved and move on to the documentation phase of the process. And typically that can take 4 to 8 weeks, or actually substantially longer if mass development is involved, if we're doing tax exempt bonds. Next slide, please. So just in terms of the some of the considerations we use in evaluating our borrowers, we like to think of things in terms of the 5 C's. So obviously, character is very important for us when we're dealing with nonprofits. We want to make sure that we're dealing with people that have integrity. They're not just good managers, but they have integrity as well. And fortunately, as lenders to nonprofits, there's other levels of oversight that ensure that we're dealing with people of character, such as boards of directors, and usually our borrowers are dealing with state and federal governments, which provide another level of oversight. The most important C, and I'll focus on that because I know that I'm running short on time here, is really the capacity or the cash flow. I mean, at the end of the day, while investors may look at increasing shareholder value when they're looking at a for-profit organization, for instance, banks, whether we're looking at a for-profit or nonprofit organization, it really does come down to whether the nonprofit has the capacity, the cash flow to service its debt obligations. And we really dig deeper than just the financial statements. We want to look into the management reports as well to determine, what are the cash flow drivers behind this entity, to give us comfort that they're going to be able to not just pay the bank back, but be able to fulfill their important mission in the community. So I think I'll stop there and turn it back to Lisa to introduce the next speaker. Lisa?
Great. Thanks, Mike. Just a ton of great information. And I know we probably could spend a whole hour just on that one slide of the 5 C's, but thanks for sharing all that information. And now I'll turn it over to William Mungai, who works in our cash management group. He helps our not-for-profits manage their most important asset, which is their cash. And with that, I'll turn it over to William.
Excellent, Lisa. Thank you so much. Again, William Mungai here, cash management. So we may ask ourselves, what's cash management? So cash management is the services or the tools that most businesses, including nonprofits, use to make their businesses much more efficient. So we talk about payables. How do you pay your vendors? How do you pay your workers? How do you pay your bills? We talk about receivables. How do you get money for the services that you do if you're a business? How do you get paid for your services that you produce? If you're a nonprofit, how do you get money in a much more efficient way without so much bureaucracy? We also look at two other aspects when we talk about cash management. We look at risk management. How do we mitigate against risk? There is so much fraud in the business landscape today, and especially in the last couple of years since the pandemic hit, we have seen a huge increase in fraud, especially on checks as well as ACH debit fraud. So there's so much of that going on right now. So we help businesses and nonprofits mitigate those risks. And the last bucket that we look at is reporting. So how do we give you the right necessary report that you need to make your day-to-day business decisions? That is so critical. So we look at trends. So can we go back to the first slide? So what are the current trends? Previous slide, please. Yeah, so in our business landscape today, we have seen a lot of demand for digital solutions. So we like to call it the 21st century. So where we are moving business operations from paper-based solutions to digital solutions. So there's a lot of demand for digital solutions. Also, as I mentioned earlier about fraud, there's a lot of cybersecurity risks. With most of the business operations going online, there's a lot of risk happening, including fraud. There is a lot of increasing regulatory pressure. So that's a trend that we are seeing in the business landscape today, as well as a request for enhanced advisory capabilities. So most businesses, they'll require a hands-on experience from a relationship standpoint, especially when it comes to banking. Clients want to have somebody that they can relate to, somebody like Mike, who is a relationship manager that they can go to if they have business needs. So those are the current trends that we see in the business landscape today. So in terms of priorities for most businesses, and this includes nonprofit as well, as I mentioned earlier, there's a huge need for liquidity. So as we know, cash is king. So we want to make sure that nonprofits are funded correctly and that they have cash to be able to run their operations correctly. Risk management, that includes fraud. I've already touched on that. The need for digital service, as well as proactive advice. So most businesses today require somebody who is proactive. So who is going up to their businesses and asking them, what are your needs today? What are your challenges today? How can I help you make your business much more efficient so that you can meet your objectives? In the case of nonprofits, what are the current trends today? So you need somebody who can be proactive in terms of managing your operations. And the last top priority that we see today is a need for an integrated platform. So we know there are so many operations the nonprofits and businesses are engaged in. So most of them are asking for an integrated platform where you can maybe do one login and be able to do all your business operations within one platform. Previously, we have seen that, and especially in the banking landscape, there are so many platforms. So you have a platform for your payables, a platform for your receivables, a platform for your reporting. So you have to log into so many different platforms. So there's a need for an integrated platform where you can do all your business operations under one login. In terms of risks, I'll highlight just two. So as we know, the economic environment can be very shifty today. So today we'll be doing one thing, and then tomorrow the world will be a different place. So there could be a war that breaks out tomorrow that changes the entire economic landscape of a business, and that includes nonprofits. Recently, we had a war in Ukraine, and we had a lot of our nonprofits that could not send or receive money to and from Russia. So we have to mitigate against all those risks. Another big risk that we see, obviously, is cybersecurity. We've already talked about fraud. And finally, reporting. Reporting is a key part of what businesses do today. Because if you don't have the right reports, the right information in order to make everyday business decisions, that can be a huge risk. And so in banking, we pride ourselves in giving you the right tools to be able to make the right decisions. Next slide, please. Now, I talked about 4 buckets: payables, receivables, reporting, as well as risk management. So when we look at payables, what are we looking at? What are we advising our business customers to do? How do we help you improve your cash flow management? Again, cash is king. We want you to be able to pay your vendors, but at the same time, we want you to be able to hold on to your money a lot longer without having to pay it faster. So we talk about achieving efficiency in terms of your payment processing. What tools can we give you to be able to make your processing your payments much more effective? So we look at that. Now, those two combined help us advise you on how to increase security in terms of fraud protection. Again, fraud has been on the increase in the last 3 years, and that has become a big, big, big risk to big businesses, including nonprofits. Next slide, please. Now, when we talk of payables, what tools are we talking about? So as much as we are in the digital landscape today, checks remain the most dominant method of payment. So when we talk about check fraud, it's still a big risk in the business today. So checks are the most dominant method of payment, as well as wires. So the ability to be able to effect a payment same day. So wires are a good way of doing that. Now, in addition to checks and wires today, we see a lot of increase in ACHs. ACH is an acronym for Automated Clearinghouse. So that's an electronic method of paying either a vendor or paying a business consumer. For nonprofits, is a way of paying people that you do business with, including receiving grants or funds from your donors. We also look at commercial credit cards. Now, commercial cards are also an efficient way of making your payables. Now, why is that important? That is important because I talked about extending your payables process. Most cards will give you a 30-day billing and 15-day grace period. That gives you a good number of days, up to 45 days to make your payables, which means instead of cutting a check, if you can be able to pay a vendor using a credit card, so you have up to 45 days to be able to pay that bill to the bank, but you've already paid your vendor. So it kind of gives you that extended a payable period, which makes sure that you stick to your money a lot longer. And again, cash is king. So we also have the ability to do international ACH payments to a number or variety of countries, and that becomes a very good way for businesses to be able to make their payments. Now, the last piece, in as far as payables are concerned, we look at integrated payables. An integrated payable solution is a solution that kind of incorporates all the above into one file. So instead of making single payments, you can include all these into one file and kind of be able to dispatch it to the bank, and then the bank helps distribute those payments out. So there are different solutions that the bank can be able to work with you to implement in a way that works best for your business. Next slide, please. Now, when you talk about receivables is a process where you are receiving funds into your organization. So in the case of nonprofits, how do you get paid faster? We know most traditionally, most vendors will send you a check. So today we talk about ACH, we talk about wires, we talk about integrated payables. So part of what we do on a day-to-day basis is to work with businesses, work with nonprofits, and help them reduce that day sales outstanding. So we want to make sure that you get paid faster. Again, cash is king. If you can be able to hold on to your money in terms of payable, but be able to receive money faster, it means you're keeping more of your money. I came from a conference yesterday, and I had a very interesting statistic that 68% of small businesses do not have a system of managing their cash flow, and that's why they struggle. So cash flow is king. So what we do here is we help businesses be able to manage their payables, manage their receivables, so that they have cash to be able to make their day-to-day businesses much more efficiently. Next slide, please. So we look at a receivable solution. So we have a bunch of them, and depending on what business a business is in. For nonprofits, if you're receiving a whole bunch of checks, so we have a lockbox solution. Logbook solution is a situation where businesses outsource the processing of checks to the bank. So we also have the ability to do remote check deposits. We call it easy deposit here at the bank. Coupled with that, we have coin and currency, which is the processing of cash. We have bill pay solutions today that most businesses can use to be able to process checks electronically. All these are receivable solutions that are at the disposal of our business customers that the bank can work with to be able to help them implement them much more efficiently. Next slide, please. Now I'm going to transition into fraud. Again, I've already touched on fraud several times. This is the fraud landscape that we are looking at today. So 39% of fraud that happens in businesses and including nonprofits is propagated internally. That's a huge number, and that's a big deal. So 39% of fraud that happens in organizations happens internally. So it's orchestrated by internal partners. 37% externally, and then 20% is a collaboration between internal partners and external partners. So now when I talk about cybersecurity, guys, you can see why that is important for a bank to be able to talk to their businesses about the need to be able to protect their assets. Now, what are the solutions that, how does that fraud happen in terms of the day-to-day business operations? So 74% of that happens through check fraud. So again, I mentioned earlier that checks are the most dominant method of payment, but that's where the most fraud happens. And that's where we every day are encouraging our business partners to transition from checks to other methods of payment, especially digital payments, because it's much more easier. You can see there, card 34%, wire fraud 40%, 33% ACH debit fraud, but checks remain the dominant method of fraud today. So next. Now, what's the impact of fraud to businesses? And these also impact nonprofit. You can see at the very top, loss of funds. Accounts can be frozen at the bank if you have consistent fraud. There's a whole process of conducting investigations when there is fraud, and especially if you don't have fraud mitigants. So that can impact your business in a big way when you have to be engaged in a lengthy fraud investigation and you have hundreds of thousands of dollars lost through fraud. Now, there is also impact when it comes to audit. If you have consistent fraud, the auditors have their eyes on you. Reputational damage, because nobody wants to do business with a company that's losing money to fraudsters. Again, inability to pay vendors. If you lose hundreds of thousands of dollars, you might run out of money to be able to do your business effectively. So really, fraud is really an important part of what you do every day. Now, what solutions can we provide to be able to help you combat fraud? We talk about dual signature. So the ability to have two signers sign a check, and especially beyond a certain threshold. So we have businesses make that decision. Any check above $10,000 require two signatures. Any check beyond $100,000 require three signatures. So that's a good deterrent to fraud. So we also have electronic solutions here. We call Positive Pay and Achieve Access. Positive Pay is a fraud mitigant against checks. So you provide certain information to the bank, and as those checks get negotiated, that information is matched, and if it doesn't match, we let you know. At the same time, Achieve Access is our ACH debit fraud protection. Now, most nonprofits do allow their vendors to come into the accounts to debit funds for whatever reason for the business they do. Now, that kind of leaves you exposed for fraud, because if you don't have a filter that tells you only so-and-so is authorized to make a debit into our account, you might be susceptible to fraud. So the bank sits down with you and walks you through how to implement those fraud solutions. Next slide, please. And again, that's it. So thank you so much for giving me that opportunity to be able to present to you today.
Great. Thank you so much, William and Mike and Hasty. Certainly, please, everyone, if you have any questions for any of our panelists, please just drop them in the chat line. We are running a little short on time, but we will send out the entire deck after this presentation. So if we don't have any questions, I want to make sure we're respectful of everyone's time. I know I have a lot of questions, but we'll keep those here. And I'll just flip it back over to Kathy to wrap us up.
Excellent. Thank you, everyone, for all of that really valuable information and insights. We appreciate it. Lots to cover here. So as Lisa said, if we will make this information available after the call, and certainly feel free to send questions in that we can answer kind of in a what-off setting. We definitely ran a little bit long, but really, really important information. So thank you to all of our panelists. We appreciate your time today. Few closing items before we depart. So first, we definitely want to hear from you about your experience on today's webinar. We'll be sending out a very short survey via email, also dropping it into the chat. So please take a few minutes to fill that out and let us know your thoughts. There is also one more great conversation to engage in as part of this series. The last session will be leveraging visibility to raise your organization's profile. This session will cover how to harness the awareness gained through the Champions Award. Citizens, experts, and representatives from local media partners will participate in this as well in order to share how to amplify your message, make a good pitch, leverage social media, and more. That panel will be November 30th from 2 to 3. We'll be hosting in-person watch parties along with that one that will have receptions following from 3 to 4, just to further congratulate and celebrate 20 years of our winners. So registration link will be dropped into the chat. You can reference the emails that have been sent out. Certainly let us know if you have any questions. So again, a huge thank you to all of our panelists, Lisa, William, Hasty, Mike. We really appreciate you taking the time, and we hope to see all of you online or in person on November 30th for the culmination of this series. Have a great day, everyone. Thank you.
Thank you.